December 11th, 2025 will likely be remembered not for a dramatic crash or a visible panic, but for a quieter failure that revealed how fragile the modern commodity system had become. On that morning, the quoted spot price of silver hovered near $62 an ounce, a level that on paper suggested abundance, liquidity, and orderly price discovery. Yet across North America, Europe, and parts of Asia, wholesalers stopped answering phones, refineries suspended new orders, and retail platforms quietly shifted from available to pre-order. The system did not seize because silver disappeared. It froze because the mechanisms designed to keep it moving could no longer function under the weight of their own assumptions. What most observers miss is that commodity markets are not primarily about materials. They are about timing, credit, and hedging. The physical metal is only one component in a layered structure built on leverage and confidence. In the silver market, that structure depends on a delicate synchronization between mines, refineries, bullion banks, futures exchanges, and downstream fabricators. Each layer assumes that the next will remain liquid enough to absorb price risk. When volatility accelerates beyond the tolerances of that chain, the material does not flow to those willing to pay the posted price. It retreats into balance sheets, vaults, and unfinished processes, technically present but functionally unavailable. This pattern is not new. In 1980, during the Hunt brothers' attempt to corner the silver market, prices surged from under $10 to nearly $50 in less than a year. The public narrative focused on speculation and regulatory intervention, but the quieter reality was a breakdown in hedging capacity. Exchanges raised margin requirements repeatedly, forcing commercial participants to post cash faster than they could generate it. Refiners and dealers, facing the same replacement risk seen decades later, withdrew supply. The spike did not end because silver was plentiful. It ended because liquidity failed in both directions. A similar dynamic emerged in 2011 when silver climbed from the mid-teens to nearly $49 in 8 months. Once again, volatility overwhelmed the ability of intermediaries to remain delta neutral. Futures margin hikes introduced to stabilize the market had the opposite effect on physical flows. Retail demand surged, but premiums exploded as wholesalers rationed inventory. The quoted price became an abstraction, increasingly disconnected from the cost and availability of real metal. Even outside precious metals, the same structural failure appears. In March 2020, oil prices briefly turned negative, not because oil had no value, but because storage, financing, and delivery obligations collapsed simultaneously. Contracts settled at levels that bore little resemblance to physical reality. Participants who believed price alone governed supply learned otherwise. The system rewarded those who controlled optionality and punished those who relied on continuous liquidity. The silver freeze of late 2025 followed this historical script with remarkable precision. The sequence was not accidental. First came a rapid price ascent that exceeded the daily and weekly volatility assumptions embedded in hedging models. Second came margin calls on futures positions held by commercial entities that were long physical and short paper. These positions were not speculative. They were structural, designed to neutralize price risk while silver was refined, minted, or fabricated. But neutrality depends on manageable price movement. When silver began moving multiple dollars per session, the futures losses demanded immediate cash, not future metal. Refineries sit at the most vulnerable point in this chain. They purchase raw doré from mines, process it over weeks, and sell finished bars into wholesale markets. During that processing window, they hedge by shorting futures contracts equal to their physical exposure. Under normal conditions, this works. Under extreme volatility, it fails. The exchange does not accept partially refined silver as collateral. It accepts cash. When margin requirements expand faster than credit lines, refineries face a choice between insolvency and paralysis. In December 2025, many chose the latter, halting new purchases and suspending output rather than risk forced liquidation. This decision propagated outward with mechanical inevitability. Wholesalers who depend on continuous bar supply found their upstream contracts canceled or delayed. Retail platforms, operating on just-in-time inventory models, discovered that orders taken at yesterday's price could not be replaced at today's terms. Selling metal became more dangerous than holding it. Inventory shifted from commercial stock to strategic reserve, not by decree but by incentive. At this point, the market entered its most misunderstood phase. Demand did not vanish, it intensified. Bids multiplied across price levels, yet offers thinned to near zero. Economically, this resembled a market with infinite demand and zero supply. But physically, silver remained abundant in vaults and unfinished batches. What disappeared was the willingness to part with it for a currency that was depreciating relative to the asset itself. Price discovery, the process by which bids and asks converge, ceased to function. The market became bid-only. This transition marks the boundary between Part 1 and Part 2 of the failure. Though no bell rang to announce it, Once the physical market decouples from the quoted price, institutions face a deeper problem: credibility. Futures prices are meant to anchor expectations, guide production, and allocate risk. When they instead become sources of instability, participants retreat. History shows that this retreat is rarely reversed quickly. In the second phase, the consequences extend beyond silver. The same bullion banks that provide hedging lines to refiners also intermediate across currencies, rates, and sovereign debt. When their counterparties strain, credit terms tighten elsewhere. This is not contagion in the emotional sense, but correlation enforced by balance sheets. In 1971, when the United States closed the gold window, officials believed the move would stabilize the dollar system. Instead, it revealed that fixed convertibility had masked underlying imbalances. Confidence adjusted downward, and volatility became a permanent feature. Similarly, in 1998, the collapse of long-term capital management exposed how widely shared risk models could fail simultaneously. The trades were sophisticated, hedged, and mathematically elegant. They unraveled because liquidity assumptions proved false under stress. Central banks intervened, not to save a fund, but to preserve the plumbing of the system. The lesson was acknowledged, then gradually forgotten. By late 2025, silver had become a case study in that forgetting. Institutions assumed that futures markets could absorb any amount of price risk given sufficient margin. They assumed that higher prices would always summon supply. They assumed that volatility could be managed with incremental rule changes. Each assumption had historical counterexamples, yet each was treated as obsolete. This time, it was said, the market was deeper, more transparent, more regulated. The reality was less reassuring. With refineries sidelined, new production slowed. With wholesalers rationing, retail access narrowed. With mints allocating output, delivery times extended into months. None of this required conspiracy or coordination. It emerged from rational responses to asymmetric risk. Holding silver carried price risk, but preserved optionality. Selling silver exchanged that optionality for cash, whose future purchasing power was uncertain. Powerful systems persist by believing that adaptation will outpace strain. Sometimes they are right. After 1980, regulatory reforms and new instruments restored a measure of order to metals markets. After 2008, capital buffers and clearing changes reduced certain vulnerabilities. Reform is possible, but it requires acknowledging structural limits rather than denying them. As of December 2025, the silver market stood at such a limit. The quoted price remained visible, but its signaling function was impaired. The supply chain had not collapsed into chaos. It had simply stopped moving. History suggests that motion resumes only when volatility subsides, or when institutions redesign the mechanisms that failed. Both paths involve cost, delay, and redistribution of risk. The unsettling conclusion is not that silver is scarce, but that liquidity is conditional. Systems built on continuous hedging assume continuity itself. When that assumption breaks, markets do not explode, they go quiet. Reform remains possible, but it will require slower prices, deeper capital, or redesigned hedging frameworks. Until then, the last known price is less a valuation than a coordinate,